Hello and welcome to CNBC Africa Special. I am Stephen Muvunyi. Now, my colleague Arnold Kwizera sat down with Rwanda's Minister of Finance and Economic Planning, Dr. Uzziel Ndagijimana, in a discussion that analyzed the GDP performance for Q3, as well as looked at ways to drive up savings and other matters of interest. Take a look.
Rwanda has just come out of an impressive Q2 performance, growth of almost 12%. Yeah,
12.2 exactly.
12.2,
yes.
To be exact. Now, what? Because we didn't foresee this coming. As the people down the side, the estimations were about 8 to 10% playing. Why was there a great leap in the growth in the second quarter of the year?
No, we are starting from already a high growth. Last year, you remember, we ended the year with 8.6%. Q1 was 8.4%, but Q2 was really exceptional.
Growth.
Yes, 12.2%. Two sectors are the main drivers of that growth. The industry sector grew at 21%. So if we go inside that sector, which is the wide sector, construction, the growth in construction was about 32%.
Is this down to things like the Kigali Arena, the Bugesera Airport?
Other infrastructure, construction.
And is it the coming in of new industries? Is the special economic zone already paying off?
Yes, manufacturing.
Yeah.
Also, manufacturing grew at 16%, which is also a double digit.
Minister, does this mean that Rwanda as a country, in terms of its exports, they're also improving? Because the balance of trade position wasn't the most favorable, and we saw this with pressures on the dollar.
I will explain that.
Okay, yes, sir.
Yes. So, that high performance in high growth in the manufacturing, in the industry in general, 21% growth in Q2 compared to the same quarter the previous year also has had impact on the growth of imports. Imports of capital goods and intermediate goods that go into those sectors for production. So this has made high growth in imports. I think for Q2 it was about 18%, while exports grew at 9.6%, almost a half. Actually, in the export, in the volumes, were very impressive, about 58% growth in the volume. So, but what is good, the growth in imports is due not to consumer goods, but for investment goods like capital goods, intermediate goods that go into industry, into construction, which also will generate more growth of the GDP.
Does this mean things like the Made in Rwanda campaign are yet to pick up, especially their contribution towards the various sectors? We're talking about, we saw it very much so in the services sector and the creative arts industry, where we're seeing a lot of the Made in Rwanda campaign. Is it picking up on steam? We're seeing the coming in of e-golf cars.
It is very visible because manufacturing growing at 16% is unusual. It means it is local production, not co-industry. This is made in Rwanda. And
what do you predict where we are going to be at, let's say maybe by the end of, when you look at the results coming in from Q3, and maybe at the end, going into the last quarter of the year?
As you recall, at the beginning of the year, we had projected 7.8% growth on annual basis. But the first two quarters give us an average of 10.3%. We still have 2 quarters. Yeah. So we have revised upwards our projections from 7.8% to 8.5%. This is the revised projection of annual GDP growth.
Is this a sign of confidence in the local manufacturers and the local industries?
We think that for the rest of the year, the two sectors will continue to do well. Even agriculture performed well because we had a 5% growth in the second quarter. So, but really the high growth is driven by the two sectors, industry and the services. We did not talk about services. Services grew at 12%. We are used to a high rate of 7-8%. By this time, we had 12%. If you go in the details, you find that transport, wholesale, the retail trade, you see the restaurant and the hotels, 13%, transport, over 17%. Yeah. So the service sector as well is growing very well.
I mean, towards the end of last year, there was a bit of pressure on the Rwandan franc. And there was, our loan book was also growing. Where do we stand in terms of borrowing as a country going into 2020? And do we expect the country to be back on the market for to put a treasury bond out there or to look for market through the bills?
No, treasury bonds are routine activities. Every quarter we issue treasury bonds. It is part of our plan, not only to raise domestic resources to finance some infrastructure project, but also to fuel the capital market. And it is in our budget approved by the parliament. In our budget, we have the projected amount to be borrowed from the local market through treasury bonds.
Now, something that hasn't performed so well when it came to Vision 2020 is the savings. We don't seem to be on track to reach the target that was set in Vision 2020. What's not happening?
You're right. You're right. Savings is a culture. To change the behavior of consumers, it takes time. But the government has put up systems and incentives to influence that change, to sensitize the population to save more. And currently we have the most recent mechanism, scheme is the long-term savings scheme that we launched in December last year. We start implementation this year. And currently we have over about 200,000 savers, ordinary people who have joined the scheme. We have more than 400 million savings from really ordinary people who just save through the mobile phone small amounts. And we have a team promoting that saving culture or in all districts. So we see from September we have seen really the figures doubling, the number of people who decide to join the scheme, but also the amount saved. So we think that with this, by the end of this year, we have a significant amount, and we continue the following year. We have already a target for the savings rate for 2024 as part of which is we want about 22% from about 10-11% currently. Actually, we want to double.
You want to double it in a period of 4 years?
No, 7 years. This target from 2017.
From 2017 to 2024?
Yes.
You want to double?
This is the national strategy for transformation, 7-year plan.
What's keeping people, apart from the lack of knowledge of the value of savings, this seems to be a trust issue as well with...
There is...
Because there's so many people want to keep the money under
there are many factors.
Yes, sir.
At least now we have the banking system everywhere, so people can save in the circles, which are really very in the community, available
in the community
near the households. People now are using also mobile system to do transaction to save money. But also the income level is also one factor. It doesn't explain everything, but it is a part of the problem. And but also the products that financial sector offer. So if you save, you don't see your interest growing, and they charge you for
keeping your money.
For keeping your money.
Yeah.
So your little money is going down with time. So there are problems with the financial banking sector. There are the level of the economy in general, also the behavior of people, but the proximity banking, which is growing now, and the technology also helping really to make transactions without really going to bank. All this combined, the scheme I was explaining,
yes,
we have even for the poor people who manage to save a certain amount per year, the government is matching that amount. If you save up to 18,000 per year, yes, the government put on your account the same amount. Your saving will double.
And you put it at 36,000.
Yes, and you pay that every quarter to people, and you see the notification on your phone. So this is also motivating people. This is something we created to incentivize the bottom population to save even whatever small they can save. If they can achieve a certain minimum, actually the government is topping up. Because we are targeting their pension. We want ordinary, yes, people, yes, without regular income, yeah, without salary, to have a pension when they reach 50, I think 55.
Yes. Talking about pension, yeah, there is one player in the pension sector at the moment, in RSSB. Yeah. Do we see legislation ensuring that we have it's opened up to the private?
It is there.
It's opened up to the private sectors. So I can go, yes, and choose to save my pension with another provider.
No, you don't. That will be complementary.
Yes,
because it will be complementary. So
that's the legislation.
If you earn a salary in private or public sector, yeah, but people in the informal sector, this self-employed,
yes,
they can go straight to their own personal savings for pension.